What's going on, everyone? So today we're diving into something that's been blowing up my DMs lately. Bit&Source subnet tokens and whether they're actually worth the hype or if we're all just gambling on AI buzzwords. Look, I'll be straight with you. This stuff is complicated, but I'm gonna break it down so even your cousin who only knows about Dogecoin can understand what's happening here. We're talking about tokens that are supposed to represent pieces of AI networks, and honestly, half the people buying them probably don't even know what they actually do. By the end of this video, you'll know how to spot the difference between a subnet token that might actually moon and one that's just riding the AI hype train straight to zero. Plus, I found this killer article from Unsupervised Capital that I'll link below, definitely worth checking out after this. Alright, let's get into it. So first things first, people keep asking me, are subnet tokens like Bitcoin? And honestly, that's like asking if Tesla stock is like gold bars. They're both valuable, but for completely different reasons. Bitcoin is basically digital gold, right? There's only ever going to be 21 million of them. The rules are set in stone, and people buy it because it's scarce, and everyone agrees it has value. It's simple. Well, as simple as revolutionary digital money can be. But subnet tokens? Dude, these things are wild. Instead of just being digital money, they represent ownership in AI networks that actually do stuff. Like one subnet might be really good at generating images, another might crush it at language processing, and another might be the go-to for analyzing data. Here's where it gets interesting. Bitcoin doesn't care if you use it or not. It just sits there being scarce and valuable. But subnet tokens? Their value is tied to how useful their AI network actually is. If nobody wants to use your subnet's AI services, your token is probably going to tank harder than my portfolio in 2022. And get this, while Bitcoin just prints new coins on a predictable schedule, subnet tokens have this crazy dynamic thing going on. The better your subnet performs, the more tokens it might get. It's like if Bitcoin gave extra rewards to the coolest miners, except instead of being cool, you have to build actually useful AI. The staking game is different too. With Bitcoin, miners just compete on raw computing power. With subnets, you're judged on the quality of your AI contributions. It's like the difference between a strongman competition and a talent show. Both require skill, but completely different types. Oh, and governance. Bitcoin changes about as fast as continental drift. Subnet communities can actually adapt and evolve their networks quickly, which is cool, but also means more things can go wrong. Okay, so here's where things get spicy. Traditional valuation methods kind of break down when you're dealing with AI network tokens, so we gotta get creative. First up, there's what I call the how busy is this thing method. Instead of looking at money transactions like with regular coins, we look at how much AI work is actually happening. Are people making API calls, running AI models? If your subnet token represents a network that nobody's using, that's probably not great for the price. But here's the catch. Sometimes being too useful can hurt the token price. If tokens move through the system super fast because everyone's using them, there might not be much buying pressure. It's like having a really popular restaurant where nobody sits down to eat. Lots of activity, but maybe not great for long-term value. Then there's the old school cash flow approach, but crypto style. We try to figure out what future rewards and emissions might look like, then work backwards to today's value. Problem is, these rewards can be all over the place and depend on validator opinions, which can be, let's say, subjective. My favorite approach is the how much of the AI pie can you eat method. We look at the total AI market that a subnet is going after, then guess what chunk they might grab? Language model subnet, they're competing for a slice of the NLP market. Computer vision subnet, they want some of that image recognition money. The token value should reflect how good they are at actually capturing and monetizing that market share. There's also this network effects thing. Basically, the more people use a network, the more valuable it becomes. Think Facebook in the early days. But with subnets, we gotta be careful about who we're counting. Are we talking about miners, validators, end users? Each subnet type has different network dynamics. Here's a fun one. The what would it cost to copy this approach? If you wanted to build a competing subnet from scratch, what would that run you? Not just the tech, but the data, the trained models, the community, all of it. Tokens should probably trade below that cost. Otherwise, someone would just build a competitor. And finally, there's the good old how does this compare to other subnets method. In the Bit&Source ecosystem, subnets are literally ranked and compete against each other. The ones that consistently perform better should probably be worth more, right? All right, let's talk about everyone's favorite three letters, APY. annual percentage yield, or as I like to call it, the number that makes people do stupid things. High APY attracts money like honey attracts bears, but here's the thing. Not all APY is created equal. Some subnet tokens are offering crazy high yields, and you gotta ask yourself, where is this money actually coming from? If the APY comes from real people paying real money to use the AI services, that's actually pretty bullish. It means there's genuine demand and revenue flowing through the system. But if it's just new tokens being printed out of thin air to pay stakers, well, that's basically just inflation with extra steps. Here's the tricky part. High token prices actually make the APY look worse for new people jumping in, which can slow down new money coming in. But if prices drop, the APY looks better, which might attract new buyers. It's like a weird financial seesaw. You also gotta think about opportunity cost. These subnet tokens aren't just competing with each other, they're competing with everything else you could do with your money. When you can get 5% risk-free from treasury bills, your subnet token better be offering a lot more than that to justify the risk. And don't forget about lockup periods. Some of these high APY deals require you to lock up your tokens for months. That's great for reducing sell pressure, but it also means you're stuck if things go south. It's like being on a roller coaster. Might be fun, but you can't get off until the ride stops. Okay, here's where I might ruffle some feathers, but I gotta keep it real with you. I think most subnet tokens are currently priced on pure hopium rather than actual fundamentals. Don't get me wrong, the AI hype is real, and some of these projects are legitimately building cool stuff. But the market is pricing in perfect execution, massive adoption, and basically everything going right for the next 5 years. That's optimistic. I'm seeing subnet tokens with similar market caps despite having completely different levels of actual usage and capability. It's like if every restaurant in town had the same Yelp rating regardless of whether they serve gourmet meals or gas station hot dogs. The market hasn't figured out how to properly differentiate between the good and the garbage yet. Here's my controversial take. Most people buying subnet tokens right now have no idea what the underlying AI networks actually do. They see AI token and high APY and their brain turns off. That's not sustainable. But here's the flip side. The good projects in this space could absolutely explode in value. We're talking about the infrastructure layer of the AI revolution here. If a subnet becomes the go-to network for a particular type of AI service, early token holders could see massive returns. The regulatory situation is still messy too. Nobody really knows if these tokens are securities, utilities, or something else entirely. A regulatory crackdown could nuke prices, but clear regulations could also legitimize the space and bring in institutional money. My strategy? I'm treating these like early stage startup investments. High risk, high potential reward, and I'm only putting in money I can afford to lose. I'm focusing on subnets with real usage, growing metrics, and teams that actually ship code instead of just hype tweets. The next year or two is going to separate the wheat from the chaff. The projects that survive and thrive will probably reward early believers handsomely, but a lot of these tokens are going to go to zero. Alright fam, that's the T on subnet token valuations. The TLDR is that these things are complicated, most people don't understand what they're buying, but there's legitimate potential for the projects that actually deliver value. Key points to remember: subnet tokens aren't Bitcoin, they're more like shares in AI companies. There are multiple ways to value them, but none of them are perfect. APY can be a trap if you don't understand where it comes from, and current prices are probably more about hype than fundamentals. If you're thinking about buying subnet tokens, please do your research. Look at actual usage metrics, understand the tokenomics, and don't just chase yield. This is still the wild west of AI infrastructure investing. Check out that unsupervised capital article I mentioned. Links in the description. It's got some solid quantitative analysis that backs up a lot of what we talked about today. What do you think? Are you bullish on subnet tokens, or do you think it's all just AI hype? Let me know in the comments, smash that like button if this helped you understand the space better, and I'll catch you in the next one. Peace out! Welcome to today's deep dive into one of the most fascinating aspects of decentralized AI infrastructure: Bit&Source subnet valuation. I'm here to break down the complex economics behind subnet alpha tokens, compare their tokenomics to Bitcoin, explore different valuation methodologies, and share my perspective on where these tokens stand in today's market. If you're involved in AI, blockchain, or just curious about how decentralized networks create value, this video will give you the framework to understand subnet valuations. We'll cover everything from fundamental tokenomics to advanced valuation models, so whether you're a researcher, investor, or developer, you'll walk away with actionable insights. Before we dive in, I want to mention that there's an excellent article by Unsupervised Capital that complements today's discussion. You'll find the link in the description below. Now, let's start with the fundamentals. To understand subnet alpha tokens, we need to first establish how they differ from Bitcoin's well-understood tokenomics model. Bitcoin operates on a relatively simple economic principle. Fixed supply cap of 21 million coins, halving events every 4 years, and value derived primarily from store of value characteristics and network adoption. Subnet alpha tokens, however, operate in a fundamentally different paradigm. While Bitcoin is designed as digital gold with predictable monetary policy, subnet tokens represent ownership stakes in specialized AI networks that provide computational services, data processing, or machine learning capabilities. The key difference lies in utility versus store of value. Bitcoin's value proposition is largely monetary. It's digital scarcity with network effects. Subnet alpha tokens derive value from the actual utility and performance of their underlying AI networks. This means their tokenomics must account for network activity, computational demand, quality of AI services, and competitive positioning within the BitInSoul ecosystem. Unlike Bitcoin's fixed supply schedule, many subnet tokens have dynamic emission rates tied to network performance metrics. High-performing subnets may receive more token emissions, creating a merit-based distribution system that doesn't exist in Bitcoin's purely time-based emission schedule. Another crucial distinction is the role of staking and delegation. While Bitcoin miners are rewarded for proof of work, subnet validators and miners are rewarded based on the quality and utility of their AI contributions. This creates a more complex economic system where token value is directly tied to network productivity rather than just computational power. The governance aspects also differ significantly. Bitcoin's governance is largely ossified by design, changing slowly through community consensus. Subnet tokens often incorporate more dynamic governance mechanisms, allowing for rapid adaptation to changing AI market conditions and technological advancement. Now, let's explore the various approaches we can take to value subnet alpha tokens. Unlike traditional assets, these tokens require hybrid valuation models that combine elements from technology valuation, utility token analysis, and network economics. The first approach is the network value to transactions ratio, adapted for AI networks. Instead of looking at financial transactions, we examine the computational transactions, API calls, and AI inference requests flowing through the network. A healthy subnet should show growing transaction volume with reasonable value to activity ratios. However, this method requires careful consideration of token velocity. High utility might actually suppress token prices if tokens move too quickly through the system. The second methodology is the discounted cash flow model, adapted for crypto networks. Here, we project future rewards and emissions that token holders might receive, then discount them back to present value. This requires assumptions about network growth, competitive positioning, and the sustainability of reward mechanisms. The challenge is that subnet rewards can be highly volatile and dependent on subjective quality assessments by validators. A third approach focuses on total addressable market analysis. We estimate the size of the AI market that a particular subnet is targeting, then assess what percentage of that market the subnet might capture. For example, a subnet focused on language models might target a portion of the natural language processing market, while a computer vision subnet might compete for image recognition services. The token value would then reflect the subnet's ability to monetize its market share. The Metcalfe's law valuation model suggests that network value grows with the square of active users. For subnets, we need to define users carefully. Are we counting miners, validators, API consumers, or end users of AI services? Each subnet type might have different network effects and user growth patterns. Another interesting approach is the cost of replication model. This asks, what would it cost to replicate this subnet's capabilities from scratch? This includes not just the technical infrastructure, but also the data, trained models, network effects, and community that make the subnet valuable. Tokens should theoretically trade below the cost of replication, or else rational actors would simply build competing networks. Finally, there's the competitive positioning model, which values tokens based on their relative performance within the bid-and-soar ecosystem. Subnets that consistently rank higher in validator assessments, attract more stake, or demonstrate superior AI capabilities should command premium valuations relative to their peers. Annual percentage yield plays a crucial role in subnet token valuations, but its impact is more nuanced than in traditional DeFi protocols. High APY can attract stakers and create buying pressure, but it can also signal inflation concerns or unsustainable tokenomics. When a subnet offers high APY, we need to understand the source of those rewards. Are they coming from genuine network revenue payments from AI service consumers? Or are they primarily inflationary rewards from new token emissions? Sustainable APY backed by real demand is bullish for long-term token value, while purely inflationary APY often leads to sell pressure as recipients liquidate rewards. The relationship between APY and token price creates interesting feedback loops. Rising token prices reduce the effective APY for new participants, potentially slowing new capital inflow. Conversely, falling prices increase APY, which might attract yield-seeking capital and provide price support. However, if falling prices are due to fundamental issues with the subnet, higher APY alone won't sustain demand. We also need to consider APY in the context of opportunity cost. Subnet tokens compete not just with each other, but with traditional DeFi yields, staking rewards from other networks, and risk-free rates. When risk-free rates are high, subnet tokens need to offer compelling risk-adjusted returns to attract capital. The duration and lockup requirements for earning APY also matter significantly. Tokens with longer lockup periods for maximum rewards create artificial scarcity and reduce sell pressure, but they also increase risk for participants who can't exit quickly if market conditions change. Based on my analysis of current market conditions and subnet fundamentals, I believe we're in an early price discovery phase where most subnet tokens are trading on speculation rather than fundamental value. This creates both opportunities and risks for participants. Many subnet tokens appear to be overvalued relative to their current utility and adoption. The excitement around AI in the bid-and-soar ecosystem has created significant hype, leading to valuations that assume rapid growth and market capture that may not materialize. However, this does not mean all tokens are overvalued. Some subnets are delivering genuine value and building sustainable economics. The quality gap between top performing and average subnets is substantial, and I expect this to be reflected more accurately in token prices over time. Currently, many subnet tokens trade within similar valuation ranges despite vastly different capabilities, adoption, and sustainability metrics. This suggests the market hasn't fully differentiated between high and low quality projects. From a portfolio perspective, I believe subnet tokens should be treated as high-risk, high-potential reward investments. The successful subnets could see tremendous appreciation as they capture market share in growing AI markets, but many will likely fail as the ecosystem matures and competition intensifies. The regulatory environment remains uncertain, which adds another layer of risk. Subnet tokens exist in a gray area between utility tokens and investment contracts, and future regulatory clarity could significantly impact valuations either positively or negatively. My recommendation is to focus on subnets with clear utility, growing adoption metrics, sustainable tokenomics, and strong technical teams. Avoid chasing pure APY plays without understanding the underlying economics, and always consider position sizing appropriate for the high-risk nature of these assets. The next 12 to 18 months will be crucial for separating legitimate subnet projects from speculative plays. Market participants who do their homework on subnet fundamentals rather than following hype will likely be rewarded, Understanding subnet token valuation requires combining traditional financial analysis with deep knowledge of AI markets, network economics, and blockchain technology. The models we've discussed today provide frameworks for analysis, but remember that this is still an emerging field where best practices are evolving rapidly. The key takeaways are: subnet tokens are fundamentally different from simple cryptocurrencies. Their value derives from AI network utility rather than monetary properties. Multiple valuation approaches should be used in combination. APY sustainability matters more than headline rates, and current market prices likely don't reflect fundamental differences between projects. For those wanting to dive deeper into this topic, I highly recommend checking out the Unsupervised Capital article linked in the description. It provides additional quantitative frameworks and data that complement today's discussion. Thank you for watching, and I'd love to hear your thoughts on subnet valuations in the comments below. Subscribe if you want more deep dives into decentralized AI economics, and I'll see you in the next video. Welcome to this technical deep dive into BitInSource subnet valuation methodologies. Today's analysis will focus on quantitative frameworks, mathematical models, and data-driven approaches to understanding subnet alpha token economics. For those familiar with traditional asset pricing models, we'll be adapting concepts from the Fama French factor models, Black-Scholes derivatives pricing, and network valuation theory to the unique characteristics of decentralized AI infrastructure tokens. The complexity of subnet valuation stems from their hybrid nature. They exhibit properties of utility tokens, governance tokens, and revenue-sharing instruments simultaneously. Our analytical framework must account for computational economics, network effects, and the stochastic nature of validator consensus mechanisms. We'll construct a multi-factor model incorporating subnet performance metrics, network utility functions, and token velocity coefficients. The mathematical rigor applied here will provide institutional-grade analysis suitable for portfolio optimization and risk management. Let's begin with a formal comparison of monetary policy mechanisms. Bitcoin operates under a deterministic emission schedule following the equation ST SHA 21000,001 EA/RT, where R represents the halving coefficient, approximately equal to 0.1386 per cycle. Subnet token emissions follow a merit-based allocation function, EST via SWI, PUI2, BT, where WI represents validator weights, PUIT is the performance score for subnet I at time t, and BT is the base emission rate. This creates a dynamic supply mechanism responsive to network utility. The fundamental difference lies in their respective utility functions. Bitcoin's utility can be modeled as UBTC, RODF, scarcity, network effects, monetary premium, while subnet tokens follow USubnet, G, computational utility, network demand, validator, hold consensus, competitive positioning. From a tokenomics perspective, Bitcoin exhibits pure monetary characteristics with value accrual through stock-to-flow dynamics. Subnet tokens demonstrate service utility characteristics where value accrual occurs through network revenue capture and performance-based token distribution. The staking mechanism introduces additional complexity through delegation dynamics. The optimal staking strategy for subnet tokens involves solving max SURI, WI, CWI, where RI represents expected returns from subnet EI, WI is the weight allocation, and CWWI is the cost function, including opportunity costs and delegation risks. Network security models also differ significantly. Bitcoin security is proportional to hash rate and energy expenditure, while subnet security depends on validator stake distribution and consensus mechanism integrity. This creates different risk profiles requiring distinct analytical approaches. Our primary valuation framework employs a modified Gordon growth model adapted for network tokens. V founds R1 plus G1, odd out G, where R1 represents first-year network revenues, G1 is the growth premium, R is the required rate of return, and G is the sustainable growth rate. The network value to transactions model requires calculating NVT halve network dollar value daily transaction volume but we must adjust for computational transactions rather than financial ones. Our modified formula becomes NVTAI market cap, daily inference count, average transaction value. For revenue generating subnets, we apply a discounted cash flow approach, PV, R or CFT is 1 plus R or T, where CFT represents the expected cash flows from network fees, adjusted for token holder distribution mechanisms and protocol revenue sharing. The Metcalfe's law application requires careful user definition. Our model uses V as 0K and A, where N represents active network participants and A varies between 1.5 to 2.0 depending on network type. Token velocity analysis employs the equation V equals GDP, M, where GDP represents network economic activity and M is the token supply. High velocity indicates utility but may suppress price appreciation. Optimal velocity for value accrual typically ranges between 3 and 7 for utility tokens. The competitive positioning model uses a multi-factor scoring system. Score, sporty or weight, Y, metric, Y, incorporating technical performance, adoption metrics, team quality, and market positioning. This creates a relative valuation framework across the subnet ecosystem. Annual percentage yield calculation for subnet tokens requires adjusting for several factors. APY adjusted, NOI for 1 plus RN, N. 1. Inflation, rate, dilution, rate, where R is the nominal rate, N is the compounding frequency, and dilution accounts for token emissions. The risk-adjusted return analysis employs the Sharpe ratio, return risk-free rate, standard deviation. For subnet tokens, we must incorporate additional risk factors, including validator slashing risks, network performance volatility, and regulatory uncertainty. Optimal portfolio allocation following modern portfolio theory requires calculating the efficient frontier, MENWSW subject to WM, MP, and W1, SHA1. Where W represents portfolio weights, S is the covariance matrix, and M represents expected returns. Duration risk for locked staking positions follows. Modified duration stack DPP show DY, where P is the token price and Y is the yield. Longer lockup periods increase duration risk, but may offer higher yields to compensate. The Kelly criterion application for position sizing, F now whole, BP, whole Q, whole B, where B is the odds, P is the probability of success, and Q is the probability of failure. For subnet tokens, this helps determine optimal allocation sizes given expected returns and risk parameters. Current market analysis reveals significant pricing inefficiencies using standard statistical measures. Our correlation analysis shows R2 values below 0.3 between subnet performance metrics and token prices, indicating substantial mispricing. Volatility analysis using Garch models demonstrates that subnet tokens exhibit higher volatility clustering than traditional cryptocurrencies, with average daily volatility ranging from 8 to 15% compared to Bitcoin's 4 to 6%. Regression analysis on network fundamentals reveals that current prices explain only 23% of variance in performance metrics. R2 new 0.23, suggesting significant opportunities for fundamental analysis-based strategies. The market cap to network revenue ratios show extreme variation, ranging from 50x to 500x, compared to traditional SaaS companies trading at 10-20x revenue multiples. This indicates either massive overvaluation or expectations of exponential growth. Statistical arbitrage opportunities exist between subnet tokens with similar functionality but different market capitalizations. Our pairs trading model identifies potential mean reversion opportunities with expected Sharpe ratios of 1.2, 1.8. Monte Carlo simulations modeling various growth scenarios suggest that current valuations require sustained 100% plus annual growth rates to justify present prices. which appears statistically unlikely based on historical network adoption patterns. Our technical analysis framework provides institutional-grade tools for subnet token valuation. Key mathematical models include the modified Gordon growth model, adjusted NVT ratios, and multi-factor scoring systems. The primary conclusion is that current market prices demonstrate significant deviation from fundamental value, with correlation coefficients below 0.3 between price and performance metrics. This creates opportunities for quantitative strategies. Risk management requires careful attention to duration risk, validator slashing probabilities, and token velocity dynamics. Optimal portfolio allocation should incorporate these factors using modern portfolio theory frameworks. For comprehensive quantitative analysis and additional mathematical models, I recommend reviewing the Unsupervised Capital research linked in the description. Their statistical analysis complements our technical framework with additional empirical data. Future research should focus on developing more sophisticated models incorporating machine learning techniques for subnet performance prediction and automated valuation updates. Thank you for your attention to this technical analysis. Hi there! If you clicked on this video, you've probably heard about something called Bit&Source subnet tokens and wondered what on earth they are. Don't worry, I'm going to explain everything from scratch, assuming you know absolutely nothing about this topic. Think of this as your friendly introduction to a new type of digital asset that combines artificial intelligence with blockchain technology. By the end of this video, you'll understand what these tokens are, how they work, and whether they might be worth your attention. I promise to keep the technical jargon to a minimum and use lots of real-world examples. If I ever use a term you don't recognize, I'll explain it right away. We're all learning together here. Before we start, there's a great article by Unsupervised Capital that goes deeper into this topic. I'll put the link in the description if you want to read more after watching. Let's start with the basics. You know how you can buy shares in Apple or Google. Well, subnet tokens are kind of like buying shares in AI companies, except these companies are actually computer networks that provide AI services. Imagine if Netflix wasn't a single company, but instead was a network of thousands of computers all working together to recommend movies. And imagine you could buy a piece of that network. That's essentially what subnet tokens represent: ownership in networks of computers that specialize in different AI tasks. Now, you might be wondering how this is different from Bitcoin. Bitcoin is like digital gold. It's valuable because it's scarce and people agree it has value. But Bitcoin doesn't really do anything productive. Subnet tokens, on the other hand, represent networks that actually provide useful AI services. For example, one subnet might be really good at understanding and generating human language. Another might excel at recognizing objects in photos. Yet another might specialize in predicting market trends. Each of these networks has its own token that represents a stake in that particular AI service. Here's where it gets interesting. The value of these tokens is supposed to be connected to how useful and popular their AI network is. If lots of people want to use a particular AI service, the token representing that network should become more valuable. It's like owning stock in a company that becomes more profitable. The tokens also give you certain rights, like voting on how the network should be run or earning rewards when the network performs well. It's a bit like being a shareholder who gets dividend payments when the company does well. This is where things get tricky. And honestly, most people are just guessing right now. But let me share some ways that experts try to figure out fair prices for these tokens. The first way is to look at how busy the network is. Just like a restaurant that's always packed is probably worth more than an empty one, an AI network that gets lots of use is probably more valuable. We can count how many AI requests the network processes each day and use that to estimate its worth. Another approach is to think about the size of the market the AI network is trying to capture. Let's say there's a subnet that helps businesses write marketing emails. We can research how much companies spend on email marketing tools each year. Then guess what percentage of that market our subnet might capture. There's also the replacement cost method. This asks, if someone wanted to build a competing AI network from scratch, how much would it cost them? This includes not just the technology, but also attracting users, training the AI models, and building a community. The token should probably be worth less than this cost, or else someone would just build a competitor. We can also compare similar subnet tokens to each other. Kind of like how real estate agents compare similar houses in the same neighborhood. If two AI networks do similar things, but one token costs twice as much, that might indicate which one is overpriced or underpriced. Some people try to predict future earnings from the network and then calculate what those future earnings are worth today. This is like figuring out how much money a rental property will make over the next 10 years, then deciding how much you'd pay for it today. The challenge is that all of these methods require making educated guesses about the future, and the AI industry is changing so fast that those guesses could be completely wrong. One thing that attracts many people to subnet tokens is something called APY, which stands for Annual Percentage Yield. This is basically the interest rate you can earn by holding or staking your tokens. Some subnet tokens offer really high APY. We're talking 20%, 50%, or even 100% per year. To put this in perspective, a savings account might give you 1 to 2% per year, so these numbers look incredibly attractive. But here's the important question: where does this high yield come from? There are two main sources, and they are very different. The good source is real revenue. If the AI network earns money from people paying to use its services, and that money gets shared with token holders, that's genuine income. It's like owning stock in a company that pays dividends from its profits. The concerning source is just printing new tokens. Some networks create new tokens out of thin air and give them to people who stake their existing tokens. This might sound great, but it's like a company paying dividends by printing more shares. It dilutes the value of existing tokens. Here is a simple way to think about it. If a network is paying you 50% APY but creating 50% more tokens each year, you're not actually getting richer. You have more tokens, but each token is worth less. High yields can also create a problem where people sell their rewards immediately, which puts downward pressure on the token price. It's like getting paid in company stock but immediately selling it. If everyone does this, the stock price falls. Okay, time for some honest talk. I think most subnet tokens are currently overpriced based on the actual usage and revenue. The AI hype has gotten ahead of reality in many cases. Here's what I'm seeing. Tokens with similar prices despite having completely different levels of actual use. It's like two restaurants having the same valuation, even though one is packed every night and the other is empty. The market hasn't figured out how to properly value these different networks yet. Many people are buying subnet tokens without really understanding what the underlying AI network does. They see AI token and high APY and get excited, but they haven't researched whether the network actually provides valuable services that people want to pay for. However, I don't think all subnet tokens are overvalued. Some networks are genuinely providing useful AI services and building sustainable businesses. The challenge is identifying which ones. I also think we're still very early in this market. As AI becomes more important in our daily lives, the networks that provide essential AI services could become extremely valuable. Early investors in the right tokens could see huge returns, but there are also significant risks. Many of these projects will probably fail as competition increases and the market matures. The regulatory environment is uncertain and there could be technical problems or security issues. My advice for beginners is to be very cautious. Don't invest more than you can afford to lose completely. Do your research on the actual AI service being provided. Look for networks with real users and real revenue, not just high APY promises. If you do decide to invest, consider it more like investing in early stage startups than buying established stocks. The potential rewards are high, but so are the risks. We've covered a lot of ground today. Let me summarize the key points. Subnet tokens represent ownership in AI networks. Their value should theoretically be tied to the usefulness of those networks. There are several ways to estimate their worth, but all involve guesswork. High APY can be attractive, but understand where it comes from, and the current market is probably overvaluing most tokens. If you're interested in learning more, definitely check out that unsupervised capital article I mentioned. The link is in the description. It has more detailed analysis and data that builds on what we discussed today. Remember, this is a rapidly evolving field, and what's true today might change tomorrow. Stay curious, keep learning, and never invest more than you can afford to lose. Thanks for watching, and I hope this helped demystify subnet tokens for you. If you have questions, leave them in the comments below. Like and subscribe if you want more beginner-friendly crypto and AI content, and I'll see you in the next video. Welcome to what might be the most contrarian take on BitInSource subnet tokens you'll hear this year. While everyone else is drinking the AI crypto Kool-Aid, I'm here to ask the uncomfortable questions that nobody wants to address. I've spent months analyzing subnet tokenomics, diving into the actual usage data, and what I've found is concerning. The gap between the narrative and reality is wider than the Grand Canyon, and retail investors are getting caught in the middle. Today, we're going to dissect the fundamental flaws in subnet token valuation, expose the circular reasoning that props up current prices, and discuss why most of these tokens might be heading for a harsh reality check. This isn't food for the sake of FUD. This is honest analysis based on data, not hopium. And yes, I'll still reference that unsupervised capital piece in the description, because even though I disagree with some of their conclusions, their data is solid. Everyone loves to compare subnet tokens to Bitcoin, but this comparison reveals why subnet tokens are actually inferior as investments. Bitcoin succeeded because it's simple, predictable, and doesn't depend on complex business or operations to maintain its value. Bitcoin's value proposition is clear: digital scarcity with network effects. You don't need to evaluate management teams, business models, or competitive landscapes. It either works as digital money or it doesn't. 17 years in, and it's working. Subnet tokens, on the other hand, are business ventures masquerading as currency investments. Each token represents a bet on a specific AI network's ability to capture market share, maintain technical competitiveness, avoid regulatory issues, and generate sustainable revenue. That's a lot of variables that can go wrong. The tokenomics comparison makes this even clearer. Bitcoin's supply schedule is mathematically guaranteed and requires no human intervention. Subnet token emissions depend on subjective validator assessments, changing network parameters, and governance decisions that can be influenced by whale token holders. Here's the uncomfortable truth: most subnet networks don't actually need their tokens to function. The AI services could be provided just as effectively with traditional payment systems. The tokens exist primarily to create investment vehicles and speculation opportunities, not because they solve real technical problems. Bitcoin's proof-of-work mechanism creates real, measurable security. Subnet tokens rely on proof-of-stake systems that concentrate power among large token holders and create circular value propositions where token price affects network security, which affects token value, a feedback loop ripe for manipulation. Let's address the elephant in the room. All these sophisticated valuation models for subnet tokens are built on fundamentally flawed assumptions. They're like elaborate mathematical models for predicting lottery numbers. Impressive looking, but ultimately meaningless. The network value to transactions ratio sounds scientific, but it's garbage in, garbage out. Most subnet transactions are validators talking to each other, not real economic activity. It's like measuring a restaurant's success by counting how many times the kitchen staff talks to each other, not how many customers actually eat there. The total addressable market approach assumes subnet networks will capture meaningful market share from established AI companies. But why would businesses switch from reliable, regulated services like OpenAI or Google Cloud AI to experimental crypto networks with unclear legal status and untested reliability? Discounted cash flow models for subnet tokens are particularly absurd. They require predicting cash flows for networks that currently generate minimal real revenue, operating in an industry that changes every 6 months, using tokens whose value affects the cash flows you're trying to predict. It's financial modeling inception. The cost of replication argument falls apart when you realize that most subnet functionality could be replicated by any competent AI team in a few months. The barriers to entry aren't the technology. They're regulatory compliance, customer trust, and distribution channels that crypto networks explicitly avoid. Metcalfe's law application to subnet networks is mathematically dishonest. Network effects in AI services are nowhere near as strong as in social networks or communication protocols. If a subnet becomes expensive or unreliable, users can switch to alternatives with minimal switching costs. The honest valuation model for most subnet tokens is pure speculation. Price hype X, Huom plus APY stone reality. Currently, hype is very high, APY is artificially inflated, and reality is approaching fast. Let's talk about the massive red flag everyone's ignoring: the unsustainable APY rates being offered by subnet tokens. When you see 50, 100% annual yields, your first question should be, who's paying for this? And the answer is usually future token buyers. Most subnet APY comes from inflationary token emissions, not network revenue. This is textbook Ponzi economics. Early participants are paid with money from later participants. The network prints tokens to pay current stakers, diluting everyone's holdings while creating the illusion of profit. The few subnets that claim revenue-based yields rarely provide transparent accounting. Where are the audited financial statements? Who are the paying customers? How sustainable are these revenue streams? The answers are usually vague references to network activity and ecosystem growth. High APY rates create perverse incentives that actually harm network development. Teams focus on maintaining token prices and yields rather than building useful AI services. Why spend time on boring things like customer acquisition when you can just adjust emission parameters to keep stakers happy? The yield farming crowd doesn't care about subnet fundamentals. They're just chasing the highest APY, ready to dump tokens the moment yields drop or better opportunities emerge. This creates extreme price volatility that makes the tokens unsuitable for their supposed use cases. Even worse, high APY requirements mean these networks need exponential user growth just to maintain current token prices. That's not a business model. It's a growth hack that works until it doesn't. The current subnet token market exhibits every classic bubble characteristic: unrealistic valuations, widespread speculation by uninformed participants, and a narrative that this time is different. Spoiler alert, it's not different. Subnet tokens with zero revenue are trading at market caps that would make profitable tech companies blush. We are seeing valuations that assume these experimental networks will not only succeed, but dominate their respective AI market segments. The hubris is staggering. The most telling sign is how disconnected prices are from actual network usage. I've analyzed networks with thousands of dollars in weekly revenue trading tokens worth millions. The math doesn't math, as the kids say. Retail investors are buying subnet tokens without understanding the underlying technology, competitive landscape, or business models. They're investing based on YouTube videos and Twitter threads, not due diligence. This is 2017 ICO mania all over again. The whale concentration in most subnet tokens is extreme. A few large holders can manipulate prices easily, creating fake breakouts and pump and dump schemes. Small investors are playing a game where they don't know the rules and the house always wins. Regulatory risk is massive and largely ignored. Securities regulators are already scrutinizing crypto networks that promise returns based on others' efforts. Most subnet tokens clearly meet the Howey test definition of securities, but they're operating in regulatory gray areas that could disappear overnight. The technical risks are equally concerning. These networks are experimental software running on experimental consensus mechanisms. Code bugs, security vulnerabilities, and network failures could wipe out token values instantly. Here's my prediction. Most subnet tokens will lose 80-90% of their current value within the next 2 years. The ones that survive will be the few that actually build sustainable businesses with real customers and revenue. The bubble will pop when either regulation arrives, a major subnet network fails catastrophically, or simply when the yield farming money moves to the next shiny object. When the music stops, there won't be enough chairs for everyone. My advice: if you own subnet tokens, have an exit strategy and stick to it. Don't let sunken cost fallacy keep you holding worthless tokens. If you're thinking about buying, ask yourself, would you invest in this business if there was no token involved? The AI revolution is real, but it's being built by companies with actual revenue models, not crypto networks sustained by inflation and speculation. Invest accordingly. Check out that Unsupervised Capital article for more data-driven analysis, even if you disagree with their conclusions. Always do your own research, especially when everyone else is telling you not to. Thanks for watching this uncomfortable dose of reality. Sometimes the market needs a skeptic. Today's analysis focuses on Bit&Source subnet tokens as a potential addition to institutional digital asset portfolios. We'll examine these assets through the lens of venture capital due diligence, infrastructure investment principles, and emerging technology allocation strategies. Our investment committee has been evaluating subnet tokens as part of our broader AI infrastructure thesis. While the asset class presents significant opportunities, it also carries substantial risks that require careful portfolio construction and risk management protocols. This analysis will address key institutional concerns: regulatory compliance, liquidity considerations, custody solutions, and correlation to existing portfolio holdings. We'll also discuss position sizing recommendations and implementation strategies suitable for institutional mandates. The research from unsupervised capital, referenced in our supporting materials, provides additional quantitative frameworks that complement our institutional analysis approach. From a portfolio construction perspective, Bitcoin and subnet tokens serve different roles despite both being blockchain-based assets. Bitcoin functions as a digital store of value with gold-like characteristics. It's a portfolio hedge against monetary debasement and systemic financial risk. Subnet tokens, conversely, represent equity-like exposure to AI infrastructure businesses. They're more comparable to investments in cloud computing providers or software-as-a-service companies than to traditional cryptocurrencies. This distinction is crucial for proper portfolio allocation and risk budgeting. The correlation profiles differ significantly. Bitcoin demonstrates negative or low correlation to traditional equity markets during stress periods, making it an effective portfolio diversifier. Subnet tokens likely exhibit higher correlation to technology stocks and growth assets, reducing their diversification benefits. From a treasury management perspective, Bitcoin's predictable monetary policy and established custody solutions make it suitable for corporate treasury allocation. Subnet tokens, with their governance mechanisms and staking requirements, present operational complexity that may not align with conservative treasury policies. The liquidity characteristics also vary substantially. Bitcoin trades across multiple regulated exchanges with deep order books and institutional-grade market makers. Subnet token liquidity is concentrated in fewer venues with wider bid-ask spreads, creating execution risk for larger position sizes. Risk management requires different approaches. Bitcoin's primary risks are regulatory and technological, while subnet tokens face business model risk, competitive displacement, and technical execution risk. The failure modes are distinct and require separate risk budgets within a portfolio framework. Our institutional valuation approach adapts traditional venture capital and infrastructure investment methodologies to the subnet token structure. We employ a three-stage analysis: technical due diligence, market opportunity assessment, and tokenomics evaluation. Technical due diligence examines the subnet's AI capabilities, competitive positioning, and technical roadmap. We evaluate the team's track record, open source contributions, and peer recognition within the AI research community. This parallels our approach to evaluating early-stage AI startups. Market opportunity assessment applies McKinsey-style total addressable market analysis to specific AI verticals. We model adoption curves, pricing power, and competitive dynamics to estimate potential network revenue. This differs from crypto-native valuation methods by focusing on real-world business fundamentals. Tokenomics evaluation examines the relationship between network success and token value accrual. Many subnet tokens suffer from weak value capture mechanisms. The network can succeed without driving meaningful token appreciation. We specifically look for tokens with strong cash flow distribution or governance utility. Our financial modeling incorporates Monte Carlo simulations across multiple scenarios: base case, steady adoption; bull case, rapid market capture; and bear case, competitive displacement. We stress test models against various market conditions and regulatory environments. Due diligence extends to operational considerations: token custody requirements, staking mechanics, governance participation, and tax implications. Institutional investors need clear operational procedures for each subnet token position. We also conduct peer analysis comparing subnet tokens within similar AI verticals. Relative valuation helps identify potentially undervalued opportunities and avoid overpriced assets riding on general market enthusiasm. From an institutional perspective, high APY offerings require careful analysis to distinguish between sustainable yield and unsustainable speculation. Our framework evaluates yield sources, sustainability metrics, and risk-adjusted return profiles. Sustainable yield derives from network revenue distributed to token holders. We conduct cash flow analysis similar to dividend stock evaluation, examining payout ratios, coverage ratios, and growth sustainability. Most subnet tokens currently fail this analysis due to minimal real revenue. Unsustainable yield from token emissions creates dilution risk that often exceeds the nominal yield benefit. Our models incorporate dilution effects, token unlock schedules, and sell pressure from yield farmers. Many high APY subnet tokens deliver negative real returns after accounting for these factors. Risk-adjusted return analysis employs modified Sharpe ratios incorporating cryptocurrency-specific risk factors, regulatory risk, technology risk, and liquidity risk. We benchmark against traditional high-yield investments and other crypto assets to establish appropriate risk premiums. Duration analysis becomes critical for locked staking positions. We model the option value of liquidity using Black-Scholes frameworks adapted for crypto assets. Longer lockup periods require higher expected returns to compensate for liquidity sacrifice. Portfolio-level analysis examines how subnet token yields affect overall portfolio risk and return. High-yield positions often increase portfolio volatility and correlation during stress periods, potentially undermining their value as alternative investments. Our recommendation is to focus on yield quality rather than yield quantity. Sustainable 8 to 12% yields from productive networks often provide better risk-adjusted returns than unsustainable 50% plus yields from speculative tokens. Current market conditions present both opportunities and risks for institutional subnet token allocation. Valuations appear elevated relative to current network fundamentals, but early-stage infrastructure investments often require paying premium prices for future potential. Our analysis suggests the market is pricing in aggressive adoption assumptions across most subnet categories. Base case scenarios for many tokens require 10x, 50x growth in network usage to justify current valuations. This creates significant downside risk if adoption disappoints. However, the institutional opportunity lies in selective allocation to high-quality subnet tokens with sustainable competitive advantages. The infrastructure layer of the AI economy will likely generate substantial value, and early positioning in winning networks could drive significant returns. Regulatory clarity represents both opportunity and risk. Clearer regulations could legitimize the space and attract institutional capital, driving prices higher. Conversely, adverse regulatory developments could severely impact token values and limit institutional participation. Our recommendation is cautious allocation within a broader digital assets portfolio. Subnet tokens should represent 5 to 15% of total crypto allocation, with individual positions limited to 1 to 2% of total portfolio value. This sizing reflects the high-risk, high-potential return nature of the investment. Implementation should focus on dollar cost averaging over 6 to 12 months to mitigate timing risk. We recommend avoiding tokens with unsustainable yield mechanics and focusing on networks with clear paths to revenue generation and token value accrual. Geographic and regulatory diversification across different subnet categories helps mitigate concentration risk. AI infrastructure includes multiple verticals, language models, computer vision, data analysis, each with distinct risk profiles and adoption timelines. For institutions considering subnet token allocation, we recommend a phased implementation approach, beginning with pilot positions in 2 to 3 high conviction opportunities. This allows for operational learning while limiting downside exposure. Custody solutions require careful evaluation. Most institutional custodians don't yet support subnet tokens, requiring specialized providers or self-custody solutions. Operational due diligence on custody providers is essential. Tax implications vary by jurisdiction and token mechanics. Staking rewards may be treated as income, while token appreciation faces capital gains treatment. Professional tax advice is essential for institutional compliance. Portfolio reporting and risk monitoring systems need updates to accommodate subnet token characteristics. Traditional crypto risk models may not capture subnet-specific risks like network performance or governance changes. The unsupervised capital research provides additional quantitative frameworks suitable for institutional analysis. Their approach complements traditional due diligence with crypto-native metrics and valuation models. Welcome to what might be the most contrarian take on BitInSource subnet tokens you'll hear this year. While everyone else is drinking the AI crypto Kool-Aid, I'm here to ask the uncomfortable questions that nobody wants to address. I've spent months analyzing subnet tokenomics, diving into the actual usage data, and what I've found is concerning. The gap between the narrative and reality is wider than the Grand Canyon, and retail investors are getting caught in the middle. Today, we're going to dissect the fundamental flaws in subnet token valuation, expose the circular reasoning that props up current prices, and discuss why most of these tokens might be heading for a harsh reality check. This isn't food for the sake of FUD. This is honest analysis based on data, not hopium. And yes, I'll still reference that unsupervised capital piece in the description, because even though I disagree with some of their conclusions, their data is solid. Everyone loves to compare subnet tokens to Bitcoin, but this comparison reveals why subnet tokens are actually inferior as investments. Bitcoin succeeded because it's simple, predictable, and doesn't depend on complex business or operations to maintain its value. Bitcoin's value proposition is clear: digital scarcity with network effects. You don't need to evaluate management teams, business models, or competitive landscapes. It either works as digital money or it doesn't. 17 years in, and it's working. Subnet tokens, on the other hand, are business ventures masquerading as currency investments. Each token represents a bet on a specific AI network's ability to capture market share, maintain technical competitiveness, avoid regulatory issues, and generate sustainable revenue. That's a lot of variables that can go wrong. The tokenomics comparison makes this even clearer. Bitcoin's supply schedule is mathematically guaranteed and requires no human intervention. Subnet token emissions depend on subjective validator assessments, changing network parameters, and governance decisions that can be influenced by whale token holders. Here's the uncomfortable truth: most subnet networks don't actually need their tokens to function. The AI services could be provided just as effectively with traditional payment systems. The tokens exist primarily to create investment vehicles and speculation opportunities, not because they solve real technical problems. Bitcoin's proof-of-work mechanism creates real, measurable security. Subnet tokens rely on proof-of-stake systems that concentrate power among large token holders and create circular value propositions where token price affects network security, which affects token value, a feedback loop ripe for manipulation. Let's address the elephant in the room. All these sophisticated valuation models for subnet tokens are built on fundamentally flawed assumptions. They're like elaborate mathematical models for predicting lottery numbers. Impressive looking, but ultimately meaningless. The network value to transactions ratio sounds scientific, but it's garbage in, garbage out. Most subnet transactions are validators talking to each other, not real economic activity. It's like measuring a restaurant's success by counting how many times the kitchen staff talks to each other, not how many customers actually eat there. The total addressable market approach assumes subnet networks will capture meaningful market share from established AI companies. But why would businesses switch from reliable, regulated services like OpenAI or Google Cloud AI to experimental crypto networks with unclear legal status and untested reliability? Discounted cash flow models for subnet tokens are particularly absurd. They require predicting cash flows for networks that currently generate minimal real revenue, operating in an industry that changes every 6 months using tokens whose value affects the cash flows you're trying to predict. It's financial modeling inception. The cost of replication argument falls apart when you realize that most subnet functionality could be replicated by any competent AI team in a few months. The barriers to entry aren't the technology. They're regulatory compliance, customer trust, and distribution channels that crypto networks explicitly avoid. Metcalfe's law application to subnet networks is mathematically dishonest. Network effects in AI services are nowhere near as strong as in social networks or communication protocols. If a subnet becomes expensive or unreliable, users can switch to alternatives with minimal switching costs. The honest valuation model for most subnet tokens is pure speculation. Price hype X, Hulmaum plus APY stone reality. Currently, hype is very high, APY is artificially inflated, and reality is approaching fast. Let's talk about the massive red flag everyone's ignoring: the unsustainable APY rates being offered by subnet tokens. When you see 50-100% annual yields, your first question should be, who's paying for this? And the answer is usually future token buyers. Most subnet APY comes from inflationary token emissions, not network revenue. This is textbook Ponzi economics. Early participants are paid with money from later participants. The network prints tokens to pay current stakers, diluting everyone's holdings while creating the illusion of profit. The few subnets that claim revenue-based yields rarely provide transparent accounting. Where are the audited financial statements? Who are the paying customers? How sustainable are these revenue streams? The answers are usually vague references to network activity and ecosystem growth. High APY rates create perverse incentives that actually harm network development. Teams focus on maintaining token prices and yields rather than building useful AI services. Why spend time on boring things like customer acquisition when you can just adjust emission parameters to keep stakers happy? The yield farming crowd doesn't care about subnet fundamentals. They're just chasing the highest APY, ready to dump tokens the moment yields drop or better opportunities emerge. This creates extreme price volatility that makes the tokens unsuitable for their supposed use cases. Even worse, high APY requirements mean these networks need exponential user growth just to maintain current token prices. That's not a business model. It's a growth hack that works until it doesn't. The current subnet token market exhibits every classic bubble characteristic: unrealistic valuations, widespread speculation by uninformed participants, and a narrative that this time is different. Spoiler alert, it's not different. Subnet tokens with zero revenue are trading at market caps that would make profitable tech companies blush. We are seeing valuations that assume these experimental networks will not only succeed, but dominate their respective AI market segments. The hubris is staggering. The most telling sign is how disconnected prices are from actual network usage. I've analyzed networks with thousands of dollars in weekly revenue trading tokens worth millions. The math doesn't math, as the kids say. Retail investors are buying subnet tokens without understanding the underlying technology, competitive landscape, or business models. They're investing based on YouTube videos and Twitter threads, not due diligence. This is 2017 ICO mania all over again. The whale concentration in most subnet tokens is extreme. A few large holders can manipulate prices easily, creating fake breakouts and pump and dump schemes. Small investors are playing a game where they don't know the rules and the house always wins. Regulatory risk is massive and largely ignored. Securities regulators are already scrutinizing crypto networks that promise returns based on others' efforts. Most subnet tokens clearly meet the Howey test definition of securities, but they're operating in regulatory gray areas that could disappear overnight. The technical risks are equally concerning. These networks are experimental software running on experimental consensus mechanisms. Code bugs, security vulnerabilities, and network failures could wipe out token values instantly. Here's my prediction. Most subnet tokens will lose 80-90% of their current value within the next 2 years. The ones that survive will be the few that actually build sustainable businesses with real customers and revenue. The bubble will pop when either regulation arrives, a major subnet network fails catastrophically, or simply when the yield farming money moves to the next shiny object. When the music stops, there won't be enough chairs for everyone. My advice: if you own subnet tokens, have an exit strategy and stick to it. Don't let sunken cost fallacy keep you holding worthless tokens. If you're thinking about buying, ask yourself, would you invest in this business if there was no token involved? The AI revolution is real, but it's being built by companies with actual revenue models, not crypto networks sustained by inflation and speculation. Invest accordingly. Check out that Unsupervised Capital article for more data-driven analysis, even if you disagree with their conclusions. Always do your own research, especially when everyone else is telling you not to. Thanks for watching this uncomfortable dose of reality. Sometimes the market needs a skeptic. Today's analysis focuses on Bit&Source subnet tokens as a potential addition to institutional digital asset portfolios. We'll examine these assets through the lens of venture capital due diligence, infrastructure investment principles, and emerging technology allocation strategies. Our investment committee has been evaluating subnet tokens as part of our broader AI infrastructure thesis. While the asset class presents significant opportunities, it also carries substantial risks that require careful portfolio construction and risk management protocols. This analysis will address key institutional concerns: regulatory compliance, liquidity considerations, custody solutions, and correlation to existing portfolio holdings. We'll also discuss position sizing recommendations and implementation strategies suitable for institutional mandates. The research from unsupervised capital, referenced in our supporting materials, provides additional quantitative frameworks that complement our institutional analysis approach. From a portfolio construction perspective, Bitcoin and subnet tokens serve different roles despite both being blockchain-based assets. Bitcoin functions as a digital store of value with gold-like characteristics. It's a portfolio hedge against monetary debasement and systemic financial risk. Subnet tokens, conversely, represent equity-like exposure to AI infrastructure businesses. They're more comparable to investments in cloud computing providers or software-as-a-service companies than to traditional cryptocurrencies. This distinction is crucial for proper portfolio allocation and risk budgeting. The correlation profiles differ significantly. Bitcoin demonstrates negative or low correlation to traditional equity markets during stress periods, making it an effective portfolio diversifier. Subnet tokens likely exhibit higher correlation to technology stocks and growth assets, reducing their diversification benefits. From a treasury management perspective, Bitcoin's predictable monetary policy and established custody solutions make it suitable for corporate treasury allocation. Subnet tokens, with their governance mechanisms and staking requirements, present operational complexity that may not align with conservative treasury policies. The liquidity characteristics also vary substantially. Bitcoin trades across multiple regulated exchanges with deep order books and institutional-grade market makers. Subnet token liquidity is concentrated in fewer venues with wider bid-ask spreads, creating execution risk for larger position sizes. Risk management requires different approaches. Bitcoin's primary risks are regulatory and technological, while subnet tokens face business model risk, competitive displacement, and technical execution risk. The failure modes are distinct and require separate risk budgets within a portfolio framework. Our institutional valuation approach adapts traditional venture capital and infrastructure investment methodologies to the subnet token structure. We employ a three-stage analysis: technical due diligence, market opportunity assessment, and tokenomics evaluation. Technical due diligence examines the subnet's AI capabilities, competitive positioning, and technical roadmap. We evaluate the team's track record, open source contributions, and peer recognition within the AI research community. This parallels our approach to evaluating early-stage AI startups. Market opportunity assessment applies McKinsey-style total addressable market analysis to specific AI verticals. We model adoption curves, pricing power, and competitive dynamics to estimate potential network revenue. This differs from crypto-native valuation methods by focusing on real-world business fundamentals. Tokenomics evaluation examines the relationship between network success and token value accrual. Many subnet tokens suffer from weak value capture mechanisms. The network can succeed without driving meaningful token appreciation. We specifically look for tokens with strong cash flow distribution or governance utility. Our financial modeling incorporates Monte Carlo simulations across multiple scenarios: base case, steady adoption; bull case, rapid market capture; and bear case, competitive displacement. We stress test models against various market conditions and regulatory environments. Due diligence extends to operational considerations: token custody requirements, staking mechanics, governance participation, and tax implications. Institutional investors need clear operational procedures for each subnet token position. We also conduct peer analysis comparing subnet tokens within similar AI verticals. Relative valuation helps identify potentially undervalued opportunities and avoid overpriced assets riding on general market enthusiasm. From an institutional perspective, high APY offerings require careful analysis to distinguish between sustainable yield and unsustainable speculation. Our framework evaluates yield sources, sustainability metrics, and risk-adjusted return profiles. Sustainable yield derives from network revenue distributed to token holders. We conduct cash flow analysis similar to dividend stock evaluation, examining payout ratios, coverage ratios, and growth sustainability. Most subnet tokens currently fail this analysis due to minimal real revenue. Unsustainable yield from token emissions creates dilution risk that often exceeds the nominal yield benefit. Our models incorporate dilution effects, token unlock schedules, and sell pressure from yield farmers. Many high APY subnet tokens deliver negative real returns after accounting for these factors. Risk-adjusted return analysis employs modified Sharpe ratios incorporating cryptocurrency-specific risk factors, regulatory risk, technology risk, and liquidity risk. We benchmark against traditional high-yield investments and other crypto assets to establish appropriate risk premiums. Duration analysis becomes critical for locked staking positions. We model the option value of liquidity using Black-Scholes frameworks adapted for crypto assets. Longer lockup periods require higher expected returns to compensate for liquidity sacrifice. Portfolio-level analysis examines how subnet token yields affect overall portfolio risk and return. High-yield positions often increase portfolio volatility and correlation during stress periods, potentially undermining their value as alternative investments. Our recommendation is to focus on yield quality rather than yield quantity. Sustainable 8 to 12% yields from productive networks often provide better risk-adjusted returns than unsustainable 50% plus yields from speculative tokens. Current market conditions present both opportunities and risks for institutional subnet token allocation. Valuations appear elevated relative to current network fundamentals, but early-stage infrastructure investments often require paying premium prices for future potential. Our analysis suggests the market is pricing in aggressive adoption assumptions across most subnet categories. Base case scenarios for many tokens require 10x, 50x growth in network usage to justify current valuations. This creates significant downside risk if adoption disappoints. However, the institutional opportunity lies in selective allocation to high-quality subnet tokens with sustainable competitive advantages. The infrastructure layer of the AI economy will likely generate substantial value, and early positioning in winning networks could drive significant returns. Regulatory clarity represents both opportunity and risk. Clearer regulations could legitimize the space and attract institutional capital, driving prices higher. Conversely, adverse regulatory developments could severely impact token values and limit institutional participation. Our recommendation is cautious allocation within a broader digital assets portfolio. Subnet tokens should represent 5 to 15% of total crypto allocation, with individual positions limited to 1 to 2% of total portfolio value. This sizing reflects the high-risk, high-potential return nature of the investment. Implementation should focus on dollar cost averaging over 6 to 12 months to mitigate timing risk. We recommend avoiding tokens with unsustainable yield mechanics and focusing on networks with clear paths to revenue generation and token value accrual. Geographic and regulatory diversification across different subnet categories helps mitigate concentration risk. AI infrastructure includes multiple verticals, language models, computer vision, data analysis, each with distinct risk profiles and adoption timelines. For institutions considering subnet token allocation, we recommend a phased implementation approach, beginning with pilot positions in 2 to 3 high-conviction opportunities. This allows for operational learning while limiting downside exposure. Custody solutions require careful evaluation. Most institutional custodians don't yet support subnet tokens, requiring specialized providers or self-custody solutions. Operational due diligence on custody providers is essential. Tax implications vary by jurisdiction and token mechanics. Staking rewards may be treated as income, while token appreciation faces capital gains treatment. Professional tax advice is essential for institutional compliance. Portfolio reporting and risk monitoring systems need updates to accommodate subnet token characteristics. Traditional crypto risk models may not capture subnet-specific risks like network performance or governance changes. The unsupervised capital research provides additional quantitative frameworks suitable for institutional analysis. Their approach complements traditional due diligence with crypto-native metrics and valuation models.
It's 2024, and Sarah, a software developer from Austin, stumbles upon something called Bittance or subnet tokens while browsing crypto Twitter at 2 a.m. Like many of us, she's heard the AI hype but never understood how regular people could actually invest in this revolution. Sound familiar? Well, Sarah's journey into subnet tokens is probably a lot like yours might be. She started with confusion, moved through excitement, faced some hard truths, and eventually learned to navigate this wild new world of AI-powered crypto tokens. Today, I'm going to tell you Sarah's story, and through it, explain everything you need to know about subnet token valuation. We'll follow her from complete beginner to informed investor, learning the same lessons she did along the way. By the end, you'll understand not just what these tokens are, but how to think about them like Sarah does now, with knowledge, caution, and just the right amount of optimism. Plus, I'll share that unsupervised capital article that helped Sarah level up her analysis game. Sarah's first question was obvious. So, these subnet tokens are like Bitcoin, right? Wrong. And this confusion nearly cost her money. Here's how Sarah learned the difference. Bitcoin, she discovered, is like owning digital gold. You buy it, hold it, and hope more people want it. Simple. The value comes from scarcity and network effects. Basic supply and demand economics that even her grandmother could understand. But subnet tokens? That's a completely different story. Sarah realized she was unbuying digital gold. She was buying shares in AI companies that don't quite exist yet. Each token represents ownership in a network of computers working together to provide AI services. The light bulb moment came when Sarah's friend Jake, a data scientist, explained it this way. Imagine if Netflix wasn't one company, but thousands of computers around the world working together to recommend movies. And imagine you could buy a piece of that network. Suddenly, it clicked. Sarah learned that while Bitcoin just sits there being scarce, subnet tokens need their underlying AI networks to actually succeed as businesses. If people don't use the AI services, the token becomes worthless. It's like owning stock in a restaurant. If nobody eats there, your investment goes to zero. The staking mechanism confused Sarah at first. With Bitcoin, you just hold it. With subnet tokens, you can stake them to earn rewards, but you're essentially betting on the network's performance. Sarah realized this was more like being an investor operator than a passive holder. The governance aspect was another eye-opener. Bitcoin never changes much. It's designed to be stable, but subnet token holders actually vote on network changes. Sarah found herself having opinions about AI model parameters and tokenomics, stuff she never thought she'd care about. Sarah's first attempt at valuing subnet tokens was optimistic. She looked at the AI market size, picked a random subnet, assumed it would capture 1% of that market, and calculated the token should be worth 10x current prices. She was about to put her savings in when her mentor, experienced investor Maria, intervened. Sarah, Maria said, you're making the classic beginner mistake. You're valuing the dream, not the reality. Maria taught Sarah to ask harder questions. Who's actually using this network? How much are they paying? Is the token even necessary for the network to function? Sarah learned her first real valuation method. The restaurant test. If the subnet is like a restaurant, how many customers does it serve daily? How much do they pay per meal? Are customers coming back? Most subnet tokens, Sarah discovered, represented restaurants with beautiful websites but empty dining rooms. The second method Maria taught was the competition check. Sarah learned to research what established AI companies were charging for similar services. If OpenAI charges $20 per million tokens for language processing, and a subnet offers the same service, the subnet's total possible revenue is limited by that benchmark. Sarah's third lesson was about token velocity, a concept that blew her mind. Even if the subnet network became hugely successful, that didn't automatically make the token valuable. If tokens just pass through the system quickly, they might not hold value. It's like trying to value a highway by how many cars drive on it. Lots of activity doesn't mean the highway itself is valuable. The skin in the game analysis became Sarah's favorite tool. She learned to check if the team behind a subnet actually held significant tokens themselves. If the founders sold all their tokens immediately, that was a red flag. But if they had locked tokens for years, they were betting on long-term success. Maria also taught Sarah about network effects, but warned her they're weaker in AI than in social media. Unlike Facebook, where more users make the platform better for everyone, AI networks face commoditization pressure. Better models can emerge overnight, making existing networks obsolete. Sarah almost fell into the classic subnet token trap. Chasing yield. She found tokens offering 80% APY, and her eyes turned into dollar signs. Fortunately, Maria was there to save her again. "Sarah, where do you think that 80% comes from?" Maria asked. This question changed everything. Sarah learned to trace yield sources like a detective. She discovered most high APY came from printing new tokens, essentially paying existing holders with inflation. It was like a company paying dividends by issuing new shares. The sustainable yield lesson was painful but valuable. Sarah found only a handful of subnets, with yield backed by actual revenue from real customers. Most were just Ponzi-like structures where early stakers got paid with money from later stakers. Sarah experienced her first yield farming death spiral secondhand through her friend Mike. Mike chased a 120% APY subnet token. Watched his token count increase daily, felt rich for 2 weeks. Then watched the token price crash 90% as farmers dumped their rewards. Mike had more tokens but less total value. An expensive lesson in inflation dynamics. The lockup dilemma taught Sarah about opportunity costs. High yields often required locking tokens for months or years. Sarah learned to ask, "What else could I do with this money?" Sometimes a 30% APY with a 1-year lockup was worse than an 8% APY with monthly withdrawal options, especially in volatile markets. Sarah developed her grandmother test for APY sustainability. I explained to my grandmother where this yield comes from without using the words tokenomics or emissions. If not, the yield was probably unsustainable. 6 months into her subnet token journey, Sarah had her first major wake-up call. The token she'd researched most carefully. One with real users, sustainable tokenomics, and a great team, dropped 60% during a market correction. This taught Sarah that even good subnet tokens were still speculative tech investments subject to crypto market cycles. Her diversified approach probably saved her from bigger losses, but it was still painful. Sarah noticed something troubling. Tokens with similar market caps but vastly different levels of actual usage and development. It was like seeing a food truck valued the same as a 5-star restaurant. The market clearly wasn't efficiently pricing these assets based on fundamentals. The regulatory scare of late 2024 hit Sarah's portfolio hard. When news broke about potential SEC enforcement actions against some subnet tokens, prices across the board crashed. Sarah learned that regulatory risk affected all tokens, regardless of their individual merits. But Sarah also witnessed the flip side. When a major subnet announced a partnership with Microsoft, its token pumped 300% in a week, lifting the entire sector. Sarah realized that positive developments in one part of the ecosystem could benefit her entire subnet token portfolio. The experience taught Sarah to think in probabilities, not certainties. She developed a mental model. Most subnet tokens will probably fail, but the ones that succeed could return 10 to 100x. I need to position size accordingly and not put all my eggs in one basket. Sarah's biggest lesson was emotional discipline. She learned to tune out the daily noise, focus on quarterly progress reports, and stick to her investment thesis. The hardest part wasn't analyzing tokens. It was managing her own psychology. A year later, Sarah reflects on her subnet token journey. She asks neither rich nor broke. Her careful approach and position. Sizing protected her from major losses while capturing some solid gains from her best picks. Her advice to new subnet token investors: start small, learn fast, and don't let FOMO drive your decisions. Treat these like startup investments, not crypto trades. Most will fail, but position yourself to benefit from the few that succeed. Sarah's portfolio now includes 3 subnet tokens. She considers core holdings tokens with real usage, sustainable economics, and strong teams. She still holds some moonshot positions in promising early-stage projects, but never more than she can afford to lose completely. Her biggest regret: not reading that unsupervised capital article sooner. It would have saved her from several rookie mistakes and helped her develop better analytical frameworks earlier in her journey. Sarah's story isn't over. The subnet token space is still evolving rapidly, but she's now equipped with the knowledge, experience, and emotional discipline to navigate whatever comes next. What about you? Are you ready to start your own subnet token journey? Remember Sarah's lessons, do your own research, and maybe you'll have your own success story to tell. Thanks for following Sarah's adventure with me today.
Hey everyone, I've been getting tons of questions about BitInSource subnet tokens in my DMs, comments, and emails. So today I'm answering the most common questions I receive about subnet token valuation. I've organized these into the questions I hear most often, from basic, what are these things, and to advanced, how do I avoid getting wrecked? We'll cover everything from comparisons to Bitcoin, to valuation methods, to that scary APY question everyone's afraid to ask. I've got 15 questions lined up that represent probably 90% of what people want to know. If your question isn't covered, drop it in the comments and I'll try to answer that or include it in a future video. Before we dive in, there's a great research piece by Unsupervised Capital that goes deeper into the quantitative side links in the description if you want the full technical analysis after this Q&A. Let's jump right into your questions. Are subnet tokens just Bitcoin with extra steps? Short answer: no, they're completely different animals. Bitcoin is digital money. You buy it, hold it, hope it goes up. Subnet tokens are like buying shares in AI companies, except the companies are decentralized networks of computers providing AI services. Think of it this way: Bitcoin is like owning gold bars. Subnet tokens are like owning shares in Netflix, except Netflix is run by thousands of computers around the world instead of one company. The value depends on whether people actually want to watch the shows, use the AI services. How do I know if a subnet token is overvalued? Great question. I look at 3 things: actual usage, are people really using the AI network? Revenue, is real money coming in? And token necessity, does the network actually need its token to function? If a subnet has $100 million market cap but only $1,000 in monthly revenue, that's a red flag. Compare that to traditional SaaS companies that typically trade at 10-20x annual revenue, not 1000x monthly revenue. Why are there so many different valuation methods for these tokens? Because nobody really knows how to value them yet. We're in the early days of a new asset class. Traditional stock valuation doesn't work perfectly, crypto valuation doesn't work perfectly, so people are trying different approaches. It's like when the internet was new. People tried to value Amazon using traditional retail metrics, but those didn't capture the full picture. We're in a similar experimental phase with subnet tokens. Should I sell my Bitcoin to buy subnet tokens? Whoa, slow down there. These serve different purposes in a portfolio. Bitcoin is your stable, boring digital gold position. Subnet tokens are your high risk, high reward startup bets. I'd never recommend going 100% into either. Bitcoin is your foundation. Subnet tokens are your speculation. Maybe 70% Bitcoin, 30% other crypto, including some subnet tokens if you're risk tolerant. How do I compare two similar subnet tokens? I use what I call the restaurant comparison method. Look at customer count, active users, revenue per customer, customer retention, and growth trajectory. Also check the team's track record and community engagement. If two subnets do similar things but one has 10x more daily users and similar market caps, that's interesting. But also ask why. Maybe the cheaper one has better technology that just hasn't been discovered yet. What's the difference between owning subnet tokens and just buying AI stocks like Nvidia? Nvidia makes money regardless of which AI companies succeed. They sell the shovels in the gold rush. Subnet tokens are bets on specific AI networks succeeding. Nvidia's diversified AI exposure. Subnet tokens are concentrated bets. Also, Nvidia is a regulated, profitable company with accounting standards. Subnet tokens are experimental networks with unclear regulations and often minimal revenue. Very different risk profiles. Is 50% APY too good to be true? Usually, yes. The key question is, where does that 50% come from? If it's from real people paying real money to use AI services and that money gets distributed to token holders, that could be sustainable. But if it's from printing new tokens to pay existing stakers, you're just getting paid in inflation. You might have more tokens, but each token is worth less. It's like getting a raise, but everyone else gets the same raise. You are not actually richer. How do I calculate the real APY after accounting for inflation? Good question. Take the nominal APY, subtract the token inflation rate, then subtract any dilution from new token unlocks. If a token offers 40% APY but inflates supply by 35% annually, your real return is maybe 5%. Also factor in price volatility. A 50% APY means nothing if the token price drops 60%. Risk-adjusted returns matter more than headline yields. Should I lock up my tokens for higher APY? Depends on your risk tolerance and market outlook. Locking tokens for higher yields is like buying a CD instead of keeping money in a savings account. You get better returns but sacrifice liquidity. In crypto, liquidity is valuable because things change fast. I generally prefer lower yields with flexibility over higher yields with long lockups, especially in volatile markets. Why do all subnet tokens seem to move together? Because most people treat them as a single category rather than individual investments. When subnet tokens are hot, money flows into all of them. When they're not, money flows out of all of them. This creates opportunities for investors who actually analyze individual projects. Eventually, the market will differentiate between good and bad subnet tokens. But right now, it's mostly trading on sector sentiment. Are we in a subnet token bubble? Probably yes. I see tokens with billion-dollar valuations but minimal real usage. Classic bubble signs: speculation exceeding fundamentals, retail FOMO, and valuations requiring perfect execution to justify it. That doesn't mean all subnet tokens are bad investments. Bubbles often identify real trends early, but it means being very selective and not paying any price just because something is AI related. How do I know when to sell? Have a plan before you buy. I set targets like sell 20 forward slow, 25% if it 3x, 50% if it 10x. Keep the rest as a moon bag. Also have stop losses for positions that turn against you. Watch for fundamental changes. If usage drops, team members leave, or competitors emerge with better technology, that might be time to reassess your position. How much of my portfolio should be subnet tokens? For most people, very little. These are extremely high-risk investments. I'd suggest no more than 5 to 10% of your total investment portfolio, and only money you can afford to lose completely. Within your crypto allocation, maybe 20-30% in subnet tokens if you're aggressive, but never bet the farm on experimental AI networks, no matter how promising they seem. Should I diversify across multiple subnet tokens or focus on one? Diversify. Most subnet tokens will probably fail, but the few that succeed could return 10 to 100x. Owning 5 to 10 different subnet tokens in various AI verticals gives you better odds of catching a winner. But don't over-diversify either. Owning 50 subnet tokens just means you own a lot of probably worthless tokens. Focus on quality over quantity. What's the most important thing to remember about subnet token investing? Don't let FOMO override your judgment. These are startup-like investments in experimental technology. Most will fail. Position size accordingly, do your homework, and be prepared for extreme volatility. The AI revolution is real, but most subnet tokens are speculation on that revolution rather than direct participation in it. Thanks for all the great questions. Check out that Unsupervised Capital Research for deeper analysis, and keep the questions coming in the comments below. What's up, everyone? Today we're doing something different. Instead of just talking about subnet tokens in isolation, we're going to compare them to everything else you could possibly invest in. By the end of this video, you'll know exactly where subnet tokens fit in the investment universe. We're talking subnet tokens versus Bitcoin versus Ethereum versus AI stocks versus traditional tech stocks versus DeFi tokens versus NFTs versus real estate versus your savings account, basically everything. I want you to walk away knowing exactly how these AI network tokens stack up against every other option for your money. This comparison approach will help you make better portfolio decisions and understand the true risk-reward profile of subnet tokens. No more wondering, should I buy this instead of that? We're going to answer those questions directly. Plus, I'll reference that killer unsupervised capital analysis that provides some great quantitative comparisons we'll build on today. Let's start with the big one, subnet tokens versus Bitcoin. This is like comparing a Tesla to a Rolls-Royce. Both are luxury vehicles, but they're built for completely different purposes. Volatility. Comparison, Bitcoin's daily volatility averages around 4.6%. Subnet tokens? We're talking 8, 10, 15% daily swings. If Bitcoin is a roller coaster, subnet tokens are a rocket ship. More thrilling, but way more dangerous. Market maturity. Bitcoin has 15 years of price history, institutional adoption, and regulatory clarity. Subnet tokens have maybe 2 years of meaningful data and exist in regulatory gray areas. Bitcoin is the seasoned veteran. Subnet tokens are the promising rookies. Value proposition. Bitcoin's pitch is simple. Digital gold, store of value, inflation hedge. Subnet tokens' pitch is complex ownership in AI networks that may or may not capture market share in industries that may or may not develop as expected. Correlation to traditional markets. Bitcoin shows negative correlation to stocks during crises, making it a portfolio diversifier. Subnet tokens likely correlate more with tech stocks and growth assets. They're risk-on investments, not risk-off hedges. Custody and operations. Bitcoin is relatively simple. Buy it, store it, maybe stake it. Subnet tokens require understanding governance, staking mechanics, validator selection, and often have lockup periods that complicate portfolio management. Winner: Bitcoin for stability and simplicity, subnet tokens for upside potential and active management opportunities. This comparison is fascinating because Ethereum and subnet tokens both represent infrastructure investments, but for different types of infrastructure. Network effects. Ethereum benefits from massive network effects. Every new application makes the platform more valuable. Subnet tokens have weaker network effects. Better AI models can emerge overnight and displace existing networks. Developer ecosystem. Ethereum has tens of thousands of developers and hundreds of applications. Most subnet networks have small teams and limited external development. Ethereum is a platform. Subnet networks are more like products. Revenue models. Ethereum generates revenue through transaction fees paid by users. Most subnet networks generate minimal revenue from actual AI service consumption. Ethereum has proven product market fit. Subnet networks are still searching for it. Token utility. ETH is required for all Ethereum transactions. Clear utility. Many subnet tokens could be replaced with traditional payment systems without affecting network functionality. Questionable utility. Scalability. Ethereum faces scalability challenges but has clear roadmaps. Layer 2's sharding. Subnet networks are often pre-scale, so scalability is theoretical rather than proven. Investment thesis. Ethereum is betting on continued growth of decentralized applications. Subnet tokens are betting on specific AI networks, capturing market share from centralized alternatives. Winner: Ethereum for proven utility and network effects, subnet tokens for potential higher returns if AI decentralization succeeds. This is where things get really interesting, comparing subnet tokens to traditional AI stocks like Nvidia, Microsoft, or Google. Revenue and profitability. AI stocks generate billions in actual revenue and profits. Subnet networks generate mostly theoretical revenue and token emissions. It's like comparing McDonald's to a food truck that might open someday. Regulatory environment. AI stocks operate under established securities laws with disclosure requirements. Subnet tokens exist in regulatory gray areas with minimal transparency requirements. Market access. Anyone can buy AI stocks through normal brokers. Subnet tokens require crypto exchanges, wallet management, and often complex staking procedures. Diversification. Nvidia benefits from AI growth regardless of which specific AI applications succeed. Subnet tokens are concentrated bets on specific AI networks succeeding. Valuation metrics. AI stocks trade at 2050x earnings with established valuation frameworks. Subnet tokens trade at infinite PE ratios because most have no earnings. Risk profile. AI stocks can decline 20 to 50% in bear markets. Subnet tokens can decline 80-95%. The upside potential is proportionally different too. Winner. AI stocks for stable exposure to AI growth. Subnet tokens for asymmetric upside if you can pick winners. Now let's compare subnet tokens to their crypto cousins. DeFi tokens like UNI, AAVE, or COMP. Revenue generation. Top DeFi protocols generate millions in real fees from actual users. Most subnet networks generate minimal revenue from AI service consumption. DeFi has proven business models. Subnet networks are still experimenting. User base. Major DeFi protocols have hundreds of thousands of active users. Most subnet networks have dozens to hundreds of active users. DeFi achieved product market fit. Subnet networks are still searching. Token utility. DeFi tokens often have clear utility, governance rights, fee sharing, protocol usage. Many subnet tokens have unclear utility beyond speculation and governance. Market maturity. DeFi went through its speculation phase in 2020-2021 and has since matured. Subnet tokens are currently in their speculation phase. DeFi survived the hype cycle. Subnet tokens are still in it. Competition. DeFi protocols compete mainly with traditional finance. Subnet networks compete with well-funded AI companies with massive resources. Sustainability. DeFi protocols prove they can generate sustainable revenue during bear markets. Subnet networks haven't been tested in prolonged bear markets yet. Winner. DeFi tokens for proven business models. Subnet tokens for being earlier in the hype cycle with more upside potential. Let's quickly compare subnet tokens to other investment options. Versus NFTs. NFTs are digital collectibles with speculative value. Subnet tokens represent actual business operations. Subnet tokens have more fundamental value, but NFTs have proven they can reach extreme valuations during hype cycles. Versus real estate. Real estate provides steady income and inflation protection. Subnet tokens provide extreme volatility and speculative returns. Different asset classes for different purposes. Versus savings accounts. Savings accounts provide 1 to 5% with no risk. Subnet tokens provide 90% to plus 1,000% with extreme risk. Only invest what you can afford to lose. Versus traditional stocks. Stocks provide ownership in profitable companies with regulatory protection. Subnet tokens provide ownership in experimental networks with regulatory uncertainty. The verdict. Subnet tokens are high-risk, high-reward investments suitable for small portfolio allocations. They're not replacements for traditional investments, but potential lottery tickets with better odds than actual lottery tickets. Check out that unsupervised capital piece for more detailed quantitative comparisons. And remember, portfolio diversification is your friend. Don't put all your eggs in any single basket, especially experimental AI network baskets. Annual percentage yield plays a crucial role in subnet token valuation, but it's more complex than traditional staking rewards. In the Bit'nSoar ecosystem, APY isn't just about holding tokens, it's about actively contributing to network utility. High APY can be a double-edged sword. On one hand, it attracts participants and provides strong holding incentives, which can support token price. On the other hand, extremely high APY often indicates high inflation rates, which can dilute existing token holders if the network isn't generating proportional value growth. The key metric to watch is real APY. That's the nominal APY minus the inflation rate. If a subnet offers 50% APY but has 60% annual inflation, holders are actually losing purchasing power at a 10% annual rate. What makes subnet APY particularly interesting is that it's tied to performance. Unlike simple staking rewards, subnet participants earn tokens by providing valuable AI services. This means APY should theoretically correlate with network productivity and value creation. However, this creates a feedback loop. As more participants join seeking high APY, the increased competition can drive down individual rewards unless network demand grows proportionally. This natural balancing mechanism helps prevent unsustainable APY levels. For valuation purposes, sustainable APY levels typically range from 8% to 25% in real terms. Anything significantly higher suggests either exceptional growth opportunity or unsustainable tokenomics that could lead to future corrections. The impact on valuation is straightforward. Higher sustainable APY increases the present value of future token holdings, supporting higher current prices. But the emphasis is on sustainable. Temporary APY spikes often lead to price volatility rather than lasting value appreciation. Let me be direct about where I see the current subnet token market. We're in the early stages of price discovery for assets that do not have established valuation frameworks. This creates both significant opportunities and substantial risks. Looking at the current landscape, I believe most subnet tokens are trading based on speculation rather than fundamental value. This isn't necessarily bad. It's typical for emerging technologies, but it means we need to be realistic about what we're buying into. The positive case is compelling. We're seeing subnets that are generating real utility, processing meaningful AI workloads, and creating tangible value for users. Some subnets are handling thousands of inference requests daily. Others are facilitating AI model training, and a few are building specialized AI services that would be difficult to replicate elsewhere. However, the current token prices often don't reflect these fundamentals. Many subnet tokens are trading at valuations that would require massive growth to justify current prices. We're seeing revenue multiples of 100x or more in some cases, which would be aggressive even for high-growth traditional companies. The disconnect stems from several factors. First, there's limited liquidity in many subnet token markets, which can lead to price distortions. Second, the complexity of valuing these assets means many investors are relying on simplified metrics or following crowd sentiment rather than conducting thorough fundamental analysis. Third, and perhaps most importantly, we're still figuring out what sustainable tokenomics look like for AI networks. The technology is evolving rapidly, and optimal economic structures are still being discovered through trial and error. My personal view is that the sector is roughly 12 to 18 months away from more rational pricing. As subnets mature, develop clearer revenue models, and demonstrate sustainable growth, we'll see valuation methods become more standardized and prices become more closely tied to fundamentals. That said, the long-term potential remains enormous. AI is transforming every industry, and decentralized AI networks could capture significant value from this transformation. The question isn't whether subnet tokens will be valuable, but which ones will succeed and at what prices. For investors, this environment requires careful selection and appropriate position sizing. Look for subnets with clear utility, growing user bases, sustainable tokenomics, and strong development teams. Avoid chasing short-term price movements or investing based solely on APY numbers. Subnet token valuation represents one of the most interesting challenges in crypto today. We're attempting to value assets that combine elements of traditional equities, utility tokens, and AI companies, all while operating in a rapidly evolving technological landscape. The key takeaways: understand the fundamental differences between subnet tokens and traditional cryptocurrencies. Use multiple valuation approaches rather than relying on any single method. Pay careful attention to real APY rather than nominal rates, and maintain realistic expectations about current market pricing. The space is evolving rapidly, and those who take the time to understand these complex dynamics will be better positioned to identify genuine opportunities among the noise. For a much deeper dive into subnet tokenomics and valuation methodologies, definitely check out the Unsupervised Capital article linked in the description. It provides additional technical detail and analysis that complements what we've covered today. What are your thoughts on subnet token valuation? Are you seeing opportunities in the current market, or do you think we're still too early? Let me know in the comments below. And don't forget to subscribe for more deep dives into the intersection of AI and crypto. Thanks for watching, and I'll see you in the next video. Welcome to an in-depth look at Score and its revolutionary computer vision subnet 44. Today we'll explore how Score is transforming the landscape of automated data annotation and computer vision applications across multiple industries. What is Score? Score represents a groundbreaking approach to computer vision technology, built on a foundation of democratizing access to real-time, fully automated, accurate, and cost-effective data annotation. At its core, Score is designed to break down the barriers that have traditionally made advanced computer vision capabilities accessible only to large corporations with substantial resources. The vision behind Score is simple yet powerful: to provide every organization, regardless of size or budget, with access to cutting-edge computer vision tools that can process and analyze video footage with unprecedented accuracy and speed. The 4 pillars of Score's value delivery. Score delivers real-world value through a carefully orchestrated 4-step process that ensures maximum efficiency and accuracy in data processing. Step 1. Annotate. The annotation phase forms the foundation of Score's entire system. This step involves the precise identification and labeling of objects, actions, and events within video footage. Unlike traditional manual annotation processes that are time-consuming and prone to human error, Score's annotation system leverages advanced machine learning algorithms to automatically identify and tag relevant elements in real time. The annotation process is designed to be incredibly granular, capturing not just basic object recognition, but also complex interactions, movement patterns, and contextual relationships between different elements in the footage. This level of detail ensures that subsequent analysis can provide meaningful insights rather than surface-level observations. Step 2. Pre-train. The pre-training phase takes the annotated data and uses it to develop robust machine learning models. This step is crucial because it's where the system learns to recognize patterns, understand context, and make intelligent predictions about what it's observing in video footage. Score's pre-training process is unique in its approach to handling diverse data types and scenarios. Rather than creating narrow single-purpose models, the pre-training phase develops flexible, adaptable models that can handle various situations and environments while maintaining high accuracy levels. The pre-training phase also incorporates continuous learning mechanisms, meaning the models become more accurate and efficient over time as they process more data and encounter new scenarios. Step 3. Merge. The merge phase is where Score's true innovation shines. This step involves combining multiple trained models and data sources to create comprehensive, multi-dimensional analysis capabilities. Rather than relying on single-point solutions, the merge phase creates a holistic understanding of the video content being analyzed. This merging process allows Score to cross-reference different types of data, validate findings across multiple models, and provide more reliable and accurate results. The merge phase also enables the system to handle complex scenarios that might challenge individual models by leveraging the collective intelligence of the entire system. Step 4. Build. The final build phase transforms all the processed data and insights into actionable outputs. This is where raw computer vision capabilities become practical solutions that businesses and organizations can immediately implement and benefit from. The build phase is highly customizable, allowing different industries and use cases to extract the specific insights and functionalities they need. Whether it's generating detailed performance analytics, creating automated monitoring systems, or providing real-time decision support, the build phase delivers tangible value to end users. Current Scale and Impact Score's computer vision subnet is currently processing footage from an impressive 280 football leagues globally. This massive scale demonstrates not only the system's technical capabilities, but also its practical reliability in real-world applications. Processing footage from 280 leagues means handling thousands of hours of video content daily, analyzing millions of individual actions and events, are maintaining consistent accuracy across different playing conditions, camera angles, and environmental factors. This scale of operation provides invaluable data for continuous system improvement and validates Score's approach to automated video analysis. The global reach of Score's current operations also means the system is constantly learning from diverse playing styles, different league regulations, and varying production qualities, making it increasingly robust and adaptable. Beyond football, universal applications. While football serves as Score's initial and primary use case, the underlying technology has been designed with universal applicability in mind. The computer vision capabilities developed for football analysis can be adapted and applied across any industry that relies on video footage for operations, monitoring, or analysis. Consider manufacturing environments where Score's technology could monitor production lines, identify quality issues, and optimize workflows. In healthcare, the same computer vision principles could assist in analyzing medical imaging or monitoring patient movements. Retail environments could benefit from customer behavior analysis, inventory monitoring, and security applications. The transportation industry presents another significant opportunity, where Score's technology could enhance traffic monitoring, improve safety systems, and optimize logistics operations. Even in agriculture, video-based monitoring of crop conditions, livestock behavior, and equipment performance could be revolutionized using Score's approach. The key advantage of Score's universal design is that organizations do not need to start from scratch when implementing computer vision solutions. The foundational models and processing capabilities developed through football analysis provide a robust starting point that can be customized and refined for specific industry needs, team expansion, and expertise. Score's commitment to excellence is reflected in its strategic team expansion, particularly the recent addition of highly experienced professionals from the sports industry. The inclusion of an experienced football coach brings invaluable real-world sports knowledge to the technical team, ensuring that the system's analysis capabilities align with actual sports strategy and understanding. Similarly, the addition of an ex-professional cricket player demonstrates Score's commitment to expanding beyond football while maintaining deep sports expertise. This combination of technical innovation and practical sports knowledge creates a unique advantage in developing truly useful and accurate sports analysis tools. These strategic hires represent more than just team growth. They represent Score's understanding that effective technology solutions require deep domain expertise. By combining cutting-edge computer vision technology with genuine sports knowledge, Score ensures that its outputs are not just technically accurate, but also practically meaningful for coaches, players, analysts, and fans. D-King, expanding the ecosystem. One of the most exciting developments in Score's ecosystem is D-King, a related project that leverages Score's computer vision technology to make sophisticated predictions in sports betting markets. D-King represents a perfect example of how Score's foundational technology can be applied to create specialized, high-value applications. D-King uses the same core computer vision and analysis capabilities that power Score's main platform, but focuses specifically on generating insights that can inform betting decisions. This involves analyzing player performance patterns, team dynamics, historical trends, and real-time game developments to create predictive models that can identify valuable betting opportunities. The relationship between Score and DKing demonstrates the platform's versatility and the potential for creating entire ecosystems of applications built on Score's technological foundation. Rather than being limited to a single use case, Score's architecture enables multiple specialized applications that can serve different market needs while sharing core technological capabilities. Major announcement at Proof of Talk Paris. The relationship between Score and DKing is set to reach a new milestone with a major announcement scheduled for the Proof of Talk conference in Paris. While specific details of this announcement remain under wraps, it represents a significant development in how Score's technology is being applied to real-world market applications. This announcement at such a prestigious venue demonstrates the growing recognition of Score's technology and its potential impact across multiple industries. The Proof of Talk conference brings together leading innovators, investors, and industry experts, making it the perfect platform for unveiling significant developments in the Score ecosystem. The timing and venue of this announcement suggests that Score and DKing are preparing to unveil capabilities or partnerships that could significantly expand their market reach and practical applications. Looking forward, the future of democratized computer vision. Score's vision extends far beyond its current applications. The ultimate goal is to create a world where advanced computer vision capabilities are as accessible and easy to implement as basic software tools are today. This democratization of technology has the potential to unlock innovation across countless industries and applications that we haven't even imagined yet. The combination of Score's technical capabilities, growing ecosystem of applications like DKing, and strategic team expansion positions the platform for significant growth and impact. As more industries recognize the value of automated video analysis and computer vision, Score's foundational technology and democratized approach will likely become increasingly valuable. Conclusion: Score and its computer vision Subnet 44 represent more than just technological innovation. They represent a fundamental shift toward democratized access to advanced computer vision capabilities. Through its four-step process of annotate, pre-train, merge, and build, Score delivers real-world value while maintaining the scalability needed to process footage from 280 football leagues globally. The platform's universal applicability, combined with strategic team expansion and exciting developments like DKing, position Score at the forefront of the computer vision revolution. As we look toward the upcoming announcement at Proof of Talk Paris and beyond, Score continues to demonstrate that powerful technology becomes truly valuable when it's accessible to everyone. For more information about Score and its ecosystem, visit ScoreVision.io. Follow. In the rapidly evolving world of artificial intelligence and computer vision, Score's Subnet 44 stands as a testament to what's possible when cutting-edge technology meets real-world application. Today, we're diving deep into the technical architecture and revolutionary approach that's reshaping how we think about automated video analysis. Score's computer vision subnet operates on a sophisticated neural network architecture that processes visual data with unprecedented precision. At its core, the system employs advanced convolutional neural networks combined with transformer architectures, creating a hybrid approach that excels at both spatial and temporal understanding of video content. The subnet's architecture is built around distributed computing principles, allowing it to handle massive data throughput while maintaining low latency. This technical foundation enables Score to process footage from 280 football leagues simultaneously, analyzing thousands of hours of content in real time without compromising accuracy or speed. Stage 1: Intelligent Annotation. The annotation stage represents a quantum leap beyond traditional labeling methods. Score's system employs multimodal learning techniques that combine visual data with contextual information, creating rich semantic annotations that capture not just what's happening, but why it's happening and how it relates to broader patterns. The annotation engine utilizes sophisticated object detection algorithms that can identify and track multiple entities simultaneously. These algorithms incorporate advanced techniques like attention mechanisms and spatial temporal reasoning, allowing the system to understand complex interactions between players, the ball, and environmental factors. What sets Score's annotation apart is its ability to capture abstract concepts like player intent, tactical formations, and momentum shifts. The system doesn't just see a player running, it understands the strategic context of that movement within the broader game situation. Stage 2, Advanced Pre-Training Architecture. The pre-training phase leverages state-of-the-art self-supervised learning techniques that allow the system to learn from vast amounts of unlabeled video data. This approach dramatically reduces the need for manual annotation while improving the system's ability to generalize across different scenarios and environments. Score's pre-training methodology incorporates contrastive learning principles, where the system learns to distinguish between similar and dissimilar video sequences. This approach helps the models develop robust feature representations that remain stable across different lighting conditions, camera angles, and playing surfaces. The pre-training process also includes multitask learning components, where the system simultaneously learns multiple related tasks. This approach improves overall performance while reducing computational requirements and training time. Stage 3. Intelligent Model Fusion. The merge phase employs sophisticated ensemble techniques that go beyond simple model averaging. Score's approach uses dynamic weighting mechanisms that adjust the contribution of different models based on the specific characteristics of the input data and the confidence levels of individual predictions. This intelligent fusion process incorporates uncertainty quantification techniques that help the system understand not just what it's predicting, but how confident it is in those predictions. This meta-learning approach enables the system to provide more reliable outputs and identify situations where human oversight might be beneficial. The merge phase also includes cross-validation mechanisms that verify predictions across multiple independent models, significantly reducing the likelihood of false positives or missed events. Stage 4. Adaptive Output Generation. The build phase transforms raw predictions into actionable insights through sophisticated post-processing pipelines. These pipelines are designed to be highly configurable, allowing different applications to extract exactly the information they need while filtering out irrelevant data. The output generation process includes temporal smoothing algorithms that ensure consistent predictions over time, eliminating the flickering or inconsistent results that can plague real-time video analysis systems. Advanced statistical modeling techniques are used to provide confidence intervals and uncertainty estimates for all outputs. Processing footage from 200 NBA football leagues represents a massive technical achievement that demonstrates Score's scalability and reliability. This global deployment involves handling diverse video formats, frame rates, and quality levels while maintaining consistent performance across all streams. The technical infrastructure supporting this scale includes distributed computing clusters, advanced load balancing algorithms, and sophisticated data pipeline management systems. Edge computing capabilities ensure low latency processing even for geographically distributed content sources. Score's technical architecture is deliberately designed with domain adaptation capabilities that allow rapid deployment across different industries. The system employs transfer learning techniques that leverage knowledge gained from football analysis to quickly adapt to new domains like manufacturing, healthcare, or transportation. The modular design of Score's neural networks allows for component-level customization without requiring complete retraining. This approach dramatically reduces the time and resources needed to deploy computer vision solutions in new industries. Domain-specific modules can be plugged into the core architecture, providing specialized capabilities for different use cases while maintaining the robustness and accuracy of the foundational system. The recent addition of an experienced football coach and ex-professional cricket player to Score's team represents a strategic approach to bridging the gap between technical capability and practical application. These additions bring invaluable domain knowledge that helps refine the system, his understanding of sports dynamics and strategic nuances. The football coach's expertise helps optimize the system's tactical analysis capabilities, ensuring that the AI's understanding of game situations aligns with professional coaching perspectives. This collaboration between technical and domain experts results in more accurate and meaningful analysis outputs. The cricket player's involvement signals Score's expansion into new sports categories while maintaining deep sport-specific knowledge. This multi-sport expertise enhances the system's ability to understand common patterns across different sports while respecting the unique characteristics of each discipline. Dekeying represents the practical application of Score's technical capabilities to the complex world of sports betting predictions. This project demonstrates how the same computer vision technology can be adapted for different analytical objectives while maintaining technical rigor. Dekeying employs sophisticated statistical modeling techniques that combine real-time video analysis with historical performance data, creating predictive models that can identify valuable betting opportunities. The system uses advanced machine learning algorithms, including gradient boosting, neural networks, and ensemble methods to generate accurate predictions. The technical architecture of Dekeying includes real-time data processing capabilities that can update predictions as games unfold, incorporating new information and adjusting probabilities based on observed events. The upcoming announcement at the Proof of Talk conference in Paris represents a culmination of Score's technical development efforts. This prestigious venue provides the perfect platform to demonstrate the practical applications and commercial viability of advanced computer vision technology. The announcement will likely showcase new technical capabilities, partnership opportunities, or expanded applications that demonstrate Score's continued innovation in the computer vision space. Score's roadmap includes several exciting technical developments that will further enhance its capabilities. These include advanced multimodal learning systems that can incorporate audio and textual data alongside visual information, creating even richer understanding of video content. Research into federated learning approaches will enable Score to improve its models while maintaining data privacy and security. This capability will be particularly important as the system expands into industries with strict data protection requirements. Advanced edge computing implementations will reduce latency and improve real-time processing capabilities, enabling new applications that require immediate response to visual events. Score's technical architecture represents more than just advanced computer vision. It represents a fundamental shift toward democratizing access to sophisticated AI capabilities. By abstracting complex technical implementations behind user-friendly interfaces, Score makes advanced computer vision accessible to organizations without deep technical expertise. The system's scalable architecture ensures that small organizations can access the same advanced capabilities as large enterprises, leveling the playing field and enabling innovation across all sectors. Conclusion: Score's computer vision Subnet 44 represents a technical tour de force that combines cutting-edge research with practical application. Through its sophisticated four-stage pipeline, global scale implementation, and cross-industry adaptability, Score is setting new standards for what's possible in automated video analysis. The combination of advanced technical capabilities, strategic team expansion, and exciting projects like Dekeying positions Score at the forefront of the computer vision revolution. As we look toward the upcoming announcements and future developments, Score continues to demonstrate that technical excellence and practical application can work hand in hand to create transformative solutions. Stay connected with Score's technical developments at ScoreVision.io. Follow the latest updates of We Build Score and track Dekeying's progress for VedKingDAO.